So now we will be looking at chapter 15, which is mainly focusing on the preparation of consolidated financial statements, which covers CSOFP and CSOPL. Okay, CSOCF, Statement of Cash Flows, is not part of your syllabus. All right, so for CSOFP, CSOPL, you must have learned something from your previous paper. Okay, everything is still relevant right here for this paper with just some top up in terms of the consolidated adjustment. All right, so the basic things I will not be covering it. Okay, I will only cover the additional item that you need to know for this paper. All right, so for CSOFP, on page 322, this is the steps that you need to have when you prepare the consolidated financial statements. I would say generally there are 5 steps. 5 steps. So step 1, as usual, this is what you have learned previously in the previous paper. So step 1, determine group structure. And for FRSM, you only need to focus on simple group. Okay, whereby they can give you one holding company and one subsidiary. Or they can give you holding company that owns one subsidiary and there is also an associate in the picture. So this part here will be covered in chapter 16 later on. All right, so step 1, determine the group structure quickly. Step 2 is the most important step, which is the net asset table for the subsidiary. And this net asset table, you can use an equation whereby you're going to fill out all the net asset of subsidiary using date of reporting must always equal to date of acquisition plus with the post reserve. Okay, so you must always make sure DOR equals to DOA plus post. Okay, step 3, which is something that we have covered earlier, calculate goodwill in step 3. Most of the time, it will be under full goodwill. Okay, step 4 is calculate consolidated retained earnings, which is CRE. So the basic formula I would say is just taking holdings retained earnings plus with subsidiaries post retained earnings times with holdings percentage. That's the basic one. The rest of this that you see here, they are all the console adjustment. So you can learn it through double entry. And if the double entry is affecting CRE, then you just need to adjust it in step 4 right here. One of the examples that we have covered earlier. Remember just now? Okay, let me go to that page first. Right here. For deferred consideration at DOR, we must do the unwinding of discount. And the double entry is debit finance cost / CRE, credit deferred consideration. So when the double entry affects CRE, that's where you will adjust it in step 4 if you are preparing the consolidated SOFP. So which means the consolidated RE will reduce by 8 in this case. All right. So you don't need to go and memorize all these adjustments here. Yeah, no need. Okay. Okay. Just need to remember this, all this here. Yeah? Just need to remember these first 2 lines are good enough. Holdings RE plus subsidiaries plus RE. Okay. Now, the last step, step 5, is to calculate non-controlling interest NCI. Basic formula, fair value of NCI at acquisition. I would say this is the value of NCI at DOA, plus with subsidiaries post-reserve times with NCI percentage. Sometimes there are some adjustment to NCI as well. Okay. Then last step is just a very fundamental step that you must always do. Once you are done with the first 5 steps above, you're going to just close off your CSOFP by adding up all the assets and liabilities for both parent and subsidiary line by line. We call this as the full consolidation basis. Okay, so to consolidate subsidiary, the method that we use is full consolidation. That's the name of the method. All right, so that should be something that you have learned previously. Now we'll move on to look at the console adjustment. Okay. So first one, this is one of the very important console adjustment. And why do we have this adjustment, fair value adjustment? Is because of that golden rule that I mentioned earlier on in IFRS 3. IFRS 3 says again, yeah, this is the golden rule. Subsidiaries, assets and liabilities must be recorded at fair value for the purpose of goodwill computation, right? And this is the fair value at the date of acquisition. So if the assets and liabilities are recorded at the carrying amount in subsidiaries book, then parent will have to make an adjustment to record it at the fair value for consolidation purpose. So this is what we call a fair value adjustment. Okay, but for exam purpose, I will say, even though you see two situations right here, you will only likely see situation 2. Because situation 1 is whereby subsidiary has already revalued the non-current asset, which means the non-current asset is already carried at fair value. And since it is already at fair value, there is no further adjustment that you need to make. So that there is nothing called fair value adjustment. You don't need to adjust anything. It's already at fair value. So fair value adjustment will only come in if subsidiary has yet to revalue its non-current asset. That means now for parent, they will have to revalue the non-current asset on the date of acquisition. If this is a gain on revaluation, then you will need to increase the asset's value and credit to the net asset. That means the net asset will increase and it must be credited to the pre, because all these adjustments are made at the date of acquisition. You will credit to pre-net asset of subsidiary and it will affect the goodwill computation, which means when you come back to look at goodwill formula right here, the net assets, the fair value on net asset will actually increase because it's a gain on revaluation. You're going to increase this net asset, all right? And as a result, goodwill will decrease, all right? So same thing, if this is a loss on revaluation, you will have to debit to pre-net assets, debit pre-net assets, and credit to the net book value, okay? Then subsequently, take note, if there's a gain on revaluation, this is done at the date of acquisition. This part here is an adjustment made at the date of acquisition. The bottom part right here is what we're going to make at the date of reporting. So at each year end, right, let's say there is subsequent changes in the fair value. So let's say at DOA, there is a gain on revaluation. Fair value has increased by 20,000. So we will record 20,000 and goodwill will be affected by 20,000, right? But subsequently, at the end of the first year, the fair value increased further. So let's say fair value increased further by another 10K. But this happened at the DOR, yeah? Okay, the one that increased at DOA is only 20,000. Subsequently, at DOR, increased by 10,000. So the question is, do we need to adjust for this 10,000? Must we record the increase of a further 10,000 at the day of reporting? Okay, so take note. In this case, it's not a must for the parent to record the increase in fair value at the DOR. You must check whether the group has a policy of using revaluation model. Excuse me. So only if the group is using revaluation model, that means if parent is using revaluation model, then yes, you will have to make the adjustment. That means you have to record this increase in fair value of 10,000 at the DOR. But if the group is using cost model, then you do not need to record. Okay? But then for the one that happened at the date of acquisition, must we check whether the group is using cost model or revaluation model? No, take note. You do not need to bother what model that the group is using. At date of acquisition, IFRS 3 rule here says that it must always be recorded at fair value, regardless of whether it is under cost model, revaluation model, it must always be recorded at fair value. Okay, so in this example, in this case at DOA, you must always record any increase or decrease in fair value, yeah? But at the DOR, please check whether the group is using revaluation model. Only if the group is using revaluation model, then you will make the adjustment. If the group is using cost model, you do not need to make the adjustment. And any adjustment at the date of reporting must be recorded in post. So look at these two, they are recorded in post, not pre. The one at DOA is always pre here. The one at DOR is always post. That's the difference. Okay. There's another thing right here on the next page. At the data reporting as well, at each year end, once you have increased the value of the asset, there will be additional depreciation for any increase in the value of non-current asset. So you must charge additional depreciation on the fair value adjustment that you have made. And this depreciation will be affecting the post period because it's being calculated at the day of reporting. So you will debit the post retained earnings of subsidiary, credit the net book value. That's all. So this is the fair value adjustment.